Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
I'm fine, Andrew. It's nice to see you so summery and ready for the long weekend.
Yes, thank you, thank you. Okay, so let's kind of dive right in. It's kind of like a little bit of a weird week this past week. Yeah, what were your kind of big takeaways? There's kind of mixed data, I guess, that's come out. Again, maybe adding to the kind of your view that the Fed may not be able to to cut rates at all this year. So yeah, what's your kind of big takeaways, and are you surprised by any of the market reactions to it?
So, I think the big story this week was the Fed. I mean, what was really striking to me was how Waller came out to make sure people understood it would be a one dot. And I suspect it's going to be a 2024 cut in the dot plot next month. Um, and I suspect it's going to be for the whole committee. And I think, and I actually published a short note on this, what is going on is that the Fed, just like us at Macro Hive, is looking at the polls, and it's becoming increasingly likely that or the risk of a Trump victory. I mean, obviously, we are more than 5 months away and all that, but on current trend and people who know this stuff and who I follow and trust think on current trend it's going to be difficult for Biden to, reverse the situation. So the risk of a Trump victory are coming into play. And what's going on is that, excuse me, right now the Fed has an easing bias, and they can't go to from an easing bias to suddenly, hiking rates. They are like a super tanker. They move slowly. So they need to go to a neutral bias, and then they need to drop little hints, and then, move to a hiking bias if they are worried by inflation. And so because they move slowly, they need to position now for the risk of a Trump victory. And I think that's what's going on. And I think the sequencing is going to be fewer dots, so fewer cuts. Sorry. So one cut in June and maybe zero cut in the September SCP. And if there is indeed a Trump victory, they can move to a neutral bias after the election. So to me, this was the most important thing of the week.
So
The
you mean
Fed.
the dot plot? You're not calling for a cut in June, just to clarify. You're not calling for any cuts this year, right?
Yes. No cuts,
Yeah.
because and the CPI made no difference. In fact, we saw in the minutes, the minutes were much more hawkish, and some market participants dismissed it because they said, oh, but since the FOMC meeting we've had the CPI. But if you look at Waller, who went out of his way, he spoke twice on Tuesday, and the second time he made sure people understood this. He was a one cut. He said maybe by the end of the year this will be time to cut, meaning only one.
Yeah.
So this really is signaling that the CPI has not changed their view, and it should not. The Waller also gave us the Fed estimate of PCE that we will get next week, core PCE month on month, around 25 basis points. But the bottom line is the drivers of high inflation, very strong economy, in my view, still overheating, and it's only going to get worse. Rent, housing inflation stuck around 6%. So they can't cut. I mean, already, if they don't cut this year, they will have done nothing while inflation will have stayed around 3%. So no way. I mean, obviously, this is based on current information. If something catastrophic happens and weakens the US economy, of course, they would cut. But no,
Right.
yeah.
So I don't think we talked about last time. I can't remember if you touched on it, but if you saw the piece, maybe it came out the previous week from Rick Reeder, where he was saying actually the Fed should cut. And like I guess he's saying like 50 to 100 basis points, because yes, there's part of the economy that's overheating, but then there's a part of the economy that is just stuck because interest rates are too high, and actually it's really hitting kind of the bottom 50%, I guess, in earners in the US, and who are dependent upon credit card debt or some kind of debt. And then the wealthier that have financial assets, they can get 5.25%, 5.5% type yield, which they can then reinvest into the economy. So it's kind of helping to force this bifurcation of the economy, which is actually hurting the lower because they're having to deal with these higher interest rates, but helping the kind of wealthier side. And the wealthier side is taking those investments and spending it on services, and that's what's keeping services high. If I read it right. Is that something that the Fed is thinking about or considering, do you think? And do you have a view on that?
So, I mean, so first of all, I never take a should approach to the Fed. I'm non-judgmental. I understand their dilemma. I try to understand their dilemma, and out of experience, I know that being a policymaker is not easy. So, as Chair Powell keeps reminding us, they have a mandate from Congress. They have to stick to the mandate. So they have to take a holistic view of the economy. Some parts will be weaker, some parts will be stronger. I think what's interesting in the story you said is that there is a distributional aspect to Fed tightening, that the people who are the first to experience Fed tightening tend to be lower income because they are more dependent on credit card debt, as you said.
Yep.
But that said, the Fed is a Fed for the whole economy, not just for those people. And I would also, to be honest, I would also question whether the Fed should encourage households' reliance on very expensive debt like credit card and probably unsustainable debts to keep going. In any event, their mandate is overall inflation and overall growth. And those are not slowing. I would add that there is an issue with high delinquency rates on credit card. In fact, I wrote about it. It is shocking that we're getting credit card delinquencies close to GFC level when the economy is booming. And in my view, it tells us perhaps something about income and wealth inequalities in the US, but also about the business model of banks. If banks were managing risk better, they would refuse to extend credit to households who are going to become delinquent, and that would help to transmit Fed tightening, but they are not. And so what does that tell you? That tells you that there are financial institutions out there that are taking on too much risk, possibly because they are having difficulties, they are not viable with sound business practices. But they are still around, and in my view, a big reason why they are still around is this operating framework that the Fed has, which is based on what they call abundant liquidity. Liquidity, it hides everything that's ugly out there. in the banking system. And so I suspect that we have X number of smaller banks that are not viable, but still continuing to extend credit, still around and helping to this shocking increase in delinquency rates.
Yeah, I mean, imagine that these delinquency rates are skyrocketing at a time when unemployment is still pretty close to 60-year lows. Yeah, I'm just not sure how it plays out, but it was just an interesting thing that the services are driven a lot by kind of the wealthier people, and wealthier people, if they were able to get cheap leverage, which in many cases they were able to 4 or 5 years ago, now they are benefiting. But do I think if you're getting 5.25, 5.5 on your money versus 4.5%, like, is that going to make you go out to dinner less? I'm not so sure. Or fly less, whatever the theory is. But I could see that the Fed is in a difficult situation, and obviously they also banks, I was going to say, they also don't want to be seen, even though they should be making financial decisions, they probably also don't want to be seen not extending credit to, to poor people for a variety of political reasons, other things potentially as well. So it'll be a tricky one. Do you see this gaining steam and having eventually a real issue on the economy, or you think it's going to be kind of constrained to like the lowest 10%, and that won't really feed through to slowing the economy?
Well, we've had a few decades of super low interest rates. I think there are lots of imbalances buried out there. And if the Fed has to hike more, not this year, but probably next year, we're going to see more of these imbalances becoming apparent. I think we're going to see more smaller banks failure. So we are going to see more of a concentration of assets in the banking system. So the Fed right now is not facing the sort of a difficult part of its mandate. The difficult part comes when, inflation is still stuck at 3%, and it becomes clear that to bring it to target 2%, they have to engineer a recession. Is it worth it? There are people like future President Trump, perhaps, who will say why the number fetishism, why 2% isn't 3% good enough, and so on and so forth. These are very serious issues. They are still ahead, and I suspect that a lot of, Waller saying, no, we won't be able to cut until the end of the year, has to do with positioning for these future dilemmas.
Right. Okay, cool. Awesome. All right, so that's kind of the time stamping. I guess we haven't had because it's London afternoon, so we haven't had not like it's a big thing, but University of Michigan sentiment, and also like 1 year, 5 year inflation expectations, which I think in the past has moved markets a little bit, especially if it shows that the downward trajectory somewhat is again stalling, or even reversing. That probably could hit markets. So outside of that stuff today, so yeah, what are your key things for next week? Probably a fairly slow week. And then the other thing is, it looks like housing data has been a bit softer recently. Do you see that as the beginning of a trend? Is that more stuff of just more properties coming on, or is it still the market's pretty stuck?
So not really. So we had two data. They are both about home sales, but they have very different implications for the inflation and growth outlook. We had existing sales that disappointed. And the thing about existing sales, it's telling you about, the tightness of the housing market. Basically, what's important there is inventories, because in terms of growth, existing sales adds nothing to demand. It's just a transfer of an existing asset to a different party. But what's important here is that we've had a collapse for the reason, people are stuck in their home because of the difference between their existing mortgage and market mortgage. So what's important in there is inventories of existing sales, and basically this disappointment means inventories are not rising, the housing market remains very tight, and we're probably not going to see a decline in housing inflation next month. The other one, new home sales, that's the sales of, a new asset that's being built. A bit of a disappointment. That said, if you look at house prices, they are going up, and house prices tend to be positively correlated with residential investment. So there was a big recovery in residential investment in the first quarter. That number we got this week was a bit of a disappointment. It's just one number. The series is volatile, but it could be that housing investment is cooling off in the second quarter. Very, very possible.
Okay. Okay, great. All right. And then anything else? Well, does anything stand out from a data or speeches standpoint for next week? Yeah, that our clients should be looking out for.
So for next week, we have the usual personal income, personal spending, PCE. So core PCE, Governor Waller has already told us it's going to be about 25 basis points, and the Fed, I trust, at least when it comes to this sort of short-term number. So no surprise here. In terms of income and personal spending, I will be looking for a continued sustained increase in real income. I don't know, about 2.5% and above, so above trend. I will be looking for a continued low household savings rate. And in fact, one of the things that is striking with the surge in immigration that we are going through is that there is no corresponding surge in remittances. So we've had enormous increase in undocumented immigration for the past 2 years. We are talking about 3 million last year, 3 million this year, as estimated by the CBO. And we are not seeing any increase in remittances, which suggests those migrants have a very low savings rate. And that could explain why the household savings rate is so low, in addition to the very strong wealth of households. So that's a key driver of my macro view, and I don't think next week's data is going to change that much. Otherwise, it will be the last week of Fed speeches before the pre-meeting blackout. Lots of speakers. Williams, I think, is speaking twice since he's a permanent member of the FOMC. I will pay special attention, but I think if he signals anything about his dots, it's going to be one cut, 2024 cut.
Okay, awesome. Okay, as we always like to do at the end, I'll just highlight a few pieces from last week. So the China Growth Tracker, which always comes out on Fridays, which is a piece from Mirza and Liang. No surprise, but continuing to see kind of hard and soft data, and also kind of more real-time data showing exports continue to be quite strong. But the housing activity and I guess general consumer activity is still pretty weak. So that's also going to be a question about inflation. So obviously there's a lot, either demand or too much exports to US and Europe. So either meaning that demand is still quite strong, or there could be an oversupply of goods in some cases. There's an amazing piece, Dominique, that you and Mirza, I guess Resh also the macro market implications of Trump 2.0, which a lot of clients have been asking for. How should they think about this? What are the risks? How to position for it? And I think we're going to try and do next week's webinar, kind of a special webinar focused specifically on this Trump 2.0 and different scenario analysis. So I think everyone should be quite excited for that one. Varesh himself released a new Commodities Weekly yesterday, talking about an idea of going long gold and short copper. And guess some of that probably is a play that, you know, this idea of the big run up in some of the base metals, maybe on a rebound in China, probably overdone or overstated. And then we're continuing for central banks to be buying gold. Bilal put out a good piece, a really interesting piece on the UK elections for our, I would say but for the small country that I currently live in, the UK, which is great. They call the snap election, even though that the Conservatives are well behind Labour in the polling right now, but that should be interesting, and also kind of what that may mean and what we should look out for in the next couple of weeks ahead of that. Some new trades in LATAM. Ben's been doing something which I think it's probably going to be monthly, maybe even every other week, which is choosing like the kind of like 3 to 4 of the kind of quant AI charts where it leverages the AI work we're doing and gives an opportunity for our clients to see like what things that our analysis is really pointing out, and in which particular markets eventually that those tools and analytics will be delivered directly to our clients, also through kind of an alert type, I guess, structure or dashboard. So this is a way to continuing to start productionize the AI quant work we're doing. So that's something to look out for. That was actually sent out early in the week. Please, everyone, look out for that, or ask if they want us to resend that. A bunch of stuff on JGB yields, which I know Bilal's been talking about now for a couple of weeks. Surprising, it's not the market talks that much about it, but Japanese 10-year yields have continued to move up, and it doesn't seem like the BOJ has that big of an issue with it. And then a whole bunch of other stuff, as always. So I'll just wish everyone a very happy bank holiday in the UK, as dual citizen bank holiday in the UK, Memorial Day in the US. For me, my happy birthday on May 20th. Usually it's a day off, but it's a work day next week. And obviously wish you like a very nice, lovely long weekend as well, Dominique.
Thank you. I hope we'll have many of our listeners join the webinar. That should be fun. Volatility ahead.
Yes. Okay, cool. Thank you. Good luck. Bye.